Wow, what a ride for silver. It has been on an absolutely incredible, you could call it an escape velocity kind of move, just captivating the entire market. But then, just when it looked like it was headed for the moon, bam, it hit a brick wall. So what on earth happened?
And that's the big question, right? That's what we're going to unpack today. What caused this high-flying commodity to suddenly slam on the brakes? We are going to follow the clues piece by piece and figure out what is really going on behind the scenes here.
And you got to understand, the stakes could not be higher. We are talking about a fresh, record-breaking high of $93.56 hit just a few days ago. I mean, when a market moves that far, that fast, you know any reversal is going to be a big deal.
So what's the primary suspect in this sudden stop? Well, it's something traders call a long weekend liquidity drain. Basically, with the markets about to close for a 3-day holiday, nobody wants to be holding a lot of risk. So here's what we're going to do. We'll unpack the clues behind this cool down. We're going to find the market's invisible walls, and then we'll lay out a game plan for today's trading session.
All right, first things first. Let's dig into the evidence. We're going to follow the trail of clues that are all pointing to why this market is taking a breather right now.
So we've got three major clues to look at. First up, there's a ceiling being created by bond yields. Then, we have a really critical warning sign coming from the silver miners themselves. And finally, we'll take a peek at what the biggest players, the smart money, are actually betting on. Let's jump into that first clue.
So clue number one is the 10-year Treasury yield. Right now, it's basically acting like a governor on an engine, It's kind of stuck right around 4.19%, and that creates this equilibrium. See, without yields spiking higher, there's really no fuel for a big panic sell-off. But on the flip side, without them dropping lower, there's no catalyst to keep the rally going. So the market is just stuck.
Okay, clue number two. We have to look at the silver miners. They are not keeping pace with the price of silver itself. And in the trading world, that is a classic divergence warning. Think about it this way. Imagine the price of apples is absolutely soaring, but the stock price of the farms that actually grow the apples is falling. It just doesn't add up, right? It's a huge sign that the smart money is quietly slipping out the back door before this long weekend.
And this brings us right to clue number three, what the big institutions are doing. On one hand, you have the commercials, the smart money. They've been aggressively selling into this rally, basically betting that things are going to cool down. But on the other hand, you have a lot of traders who are just closing out their winning bets. They're taking profits off the table. They're not making new bets that the price will fall. So what does that tell us? It points more towards a gentle drift lower, not some catastrophic crash.
Okay, let's move on to our next section, because this is where it gets really interesting. We're going to look at the options market. This is where you find these invisible walls, these key price levels that really define the battlefield for traders, especially on a big expiration day like today.
But before we can see those walls, you have to understand this one term, implied volatility. It's basically the market's fear gauge, and right now it's at an extreme level of 82.61. To put that in perspective, it's like trying to buy home insurance during a hurricane. It's going to be incredibly expensive. And that high price makes buying options super risky because that premium can just vanish in a puff of smoke.
And here is that first invisible wall, the call wall, right at $92.50. A huge number of call options were sold right at this level. Now what that means is the big dealers who sold them stand to lose a ton of money if the price goes above this price. So they have a massive incentive to act as a ceiling and keep the price from breaking through.
Now, right in the middle of the whole range, we have the pivot at a nice round $90. And this level acts like a magnet. See, on an options expiration day, the price often gets pulled right to a big number like this. Why? Well, it's because that price causes the maximum number of both calls and puts to expire worthless, which is exactly what the folks who sold them want to happen.
And finally, on the downside, we have our floor, the put wall at $87.50. And it's the exact same logic as the call wall, just in reverse. There's a huge pile of put options here. So if the price drops this low, dealers will be forced to start buying to protect their positions, and that creates a really strong floor of support.
So, there you have it. We've analyzed all the clues. We've identified the key levels, the invisible walls. Now let's put it all together into a practical game plan with 3 potential scenarios for today's trading session.
Okay, here is the breakdown of how things could play out. The most likely scenario, with about a 60% probability, is what's called the pin and drift. This is where we just kind of chop around in a range, as the big dealers keep the price contained. Then you've got the Friday flush, a 25% chance we see a sharp drop if yields spike or panic sets in. And last, the wild card, the squeeze. It's a low, 15% chance of a big breakout if some unexpected world news hits.
So how do you actually trade this setup? Well, the first strategy is the holiday fade. It gets a solid 3-star rating. The logic here is pretty simple. You know traders are going to be closing out their positions to avoid risk over the weekend. So you look to short a weak little rally into that resistance area, expecting it to run out of steam.
Now, a higher-rated 4-star strategy is called the gamma pin. Here, instead of trying to pick a direction, you're just betting that the range is going to hold. You fade the edges, so you're buying near the lows and selling near the highs, and you totally avoid that messy middle part, what some people call the kill zone, where the market is just likely to chop everyone up.
And all of this brings us to what is probably the most important takeaway for today. The big theme here is defense. With volatility this extreme and a 3-day weekend right around the corner, sometimes the absolute smartest trade is no trade at all. Remember, cash is a position, and the professional move is often to end the week flat, live to fight another day, and just preserve your capital.
And if we look ahead into next week, that sentiment really carries over. The market is pricing in a 55% chance of a further correction, a 35% chance we just stay stuck in this range, and get this, only a tiny 10% chance of actually breaking out to new highs. The odds are clearly skewed towards playing defense.
Which leaves us with this final thought to chew on. When all the signs are pointing to this much uncertainty and risk, and you know the professionals are stepping to the sidelines, is the smartest move to simply not play at all. It's a really crucial lesson in risk management, and it's something every single trader should be thinking about today.